The stock bulls took a breather yesterday, but the sell-off in the US dollar continued, sending the euro dollar above the 1.11 level, cable above the 1.30 psychological mark, and gold to a fresh record. Now the US dollar is oversold and the levels call for a correction. But will that arrive? We will see. So welcome. This is Swissquote's Daily Market Talk. So the August rally cooled down yesterday as investors paused and took a breather. Now, there was no major news on the news wire to trigger the minor sell-off that we saw yesterday, so it was probably nothing else than just a correction after a long rally following an ugly meltdown. As such, the S&P 500 and Nasdaq were slightly down by around 0.20% each yesterday, close to their all-time high levels. The European Stoxx 600 index retreated a bit more than that by some 0.47% yesterday, but nothing major either, while the Japanese Nikkei index gave back some of yesterday's gains in Tokyo as the dollar yen fell and consolidated near the 145 level since yesterday. But all in all, well, there is nothing major since we talked yesterday. The US dollar index took another dive on the other hand and hit the lowest level since the beginning of January this year. And while Citi analysts said that the carry trade is back, but not with the Japanese yen, but with the US dollar instead. Now, they said that the positioning in the US dollar comes as a macro risk gauge deep below neutral, but they also warned that there is just only a small tiny window of opportunity for this strategy to perform well as the election risks in the US are looming. But I also think that the Federal Reserve risks are looming as well, and that the greenback that's now in the oversold territory according to the RSI index on a daily DXY chart, well, doesn't look appetizing for further shorting the US dollars either. But anyway, well, Citi analysts think that the US dollar is good to borrow to buy risky assets instead of the traditional Japanese yen. You do what you do with it. Now, data-wise, the final inflation numbers from the Eurozone that were released yesterday brought no surprise on the table. The core inflation remained steady at 2.9% level, while the headline inflation ticked slightly higher from 2.5% to 2.6%. Now, the numbers were soothing, but the slowing disinflation in the Eurozone and the strong wages growth in many European countries, including France, Spain, and Germany, were pointed as worrying signals for the European Central Bank's struggle to bring inflation down to its 2% monetary policy target. The latter means that the ECB may not lower its interest rates as fast as investors previously thought they could after the anticipated September rate cut from the ECB on the coming weeks. The waning dovish expectations gave a boost to the single currency at yesterday's trading session. As such, the euro dollar spiked past the 1.11 level, and the US dollar's broad-based weakness obviously helped sending the euro dollar higher. Now, the euro dollar is in the overbought territory according to the RSI index, and a downside correction would be healthy at the current levels. Now, across the channel, the weak US dollar pushed cable above an important psychological mark, which is the 1.30 level. The pair never traded meaningfully above this level since 2022, and a meaningful appreciation of sterling against the US dollar above this level means more to sterling bulls than just a policy divergence between the Federal Reserve and the Bank of England. Because the journalists that write the London Rush report for Bloomberg, well, they actually think that it could mean a real sign of a change of attitude toward sterling, obviously coupled with these better looking economic data from the UK recently and also the recent government change. Elsewhere, though, the tone from central banks were mixed and expectations were mixed as well. In Sweden, for example, Riksbank cut its rate by 25 basis points yesterday and said that it could lower its rates 3 more times this year. But despite that dovishness from Riksbank, the Swedish krona advanced against the greenback at yesterday's trading session, and the dollar SEK fell to the lowest level since March this year. And across the Atlantic Ocean, inflation in Canada fell from 2.7 to 2.5% in July, as expected, and that marked the softest increase in consumer prices since March of 2021. Now, core inflation fell to 1.7% level. The numbers were aligned with the Bank of Canada's forecast that inflation would drop toward the 2.5% mark in the second half of this year. Now, all the inflation is expected to rebound due to incoming base effects for gasoline prices, while the numbers that we saw in Canada backed the dovish Bank of Canada expectations yesterday. Yet here as well, the loonie was bid against a wildly offered US dollar, and even the sell-off in crude oil prices didn't give cold feet to the Canadian dollar bulls. As such, the USD CAD fell to 1.36 level and is about to test the 200-day moving average to the downside. And it's needless to say that the pair is also approaching an oversold territory right now and should see traders take a break and breathe and think about what to do next. So yes, ladies and gentlemen, all in all, no matter the news flow right now or the idiosyncratic expectations for the central banks, the major story of the moment is the US dollar's weakness that I think has stretched to unfunded levels, as you know. So today, the US dollar traders will have a close look to the latest FOMC meeting minutes and the BLS preliminary revision to annual payrolls. Now, I don't really think that we will have anything that we didn't know from the Federal Reserve's latest meeting minutes. Plus, so much has changed since the last FOMC meeting, with market expectations regarding rate cuts going to wild places. But the BLS revision to payrolls could actually be interesting in that, economists at places like Goldman Sachs and Wells Fargo, they expect that the revisions to payrolls will show that the payrolls growth in the US in the year through March was at least 600,000 lower than currently thought. And Goldman Sachs says that the revision could be as much as 1 million jobs lower, while JP Morgan thinks that the numbers will be revised by around 360,000 jobs to the downside. Now, obviously, the bigger the downside revision to payrolls, the higher the worries that the Federal Reserve has waited too long before normalizing its policy, and the crazier the Federal Reserve dose could go, and the higher the pressure will be on the US dollar to the downside, of course. But if the numbers don't show any surprise, we could see the US dollar rebound. And of course, the dollar's misery is making gold shine like a new penny these days. The precious metal advanced to a fresh record high at yesterday's trading session, backed by the rising expectation of Federal Reserve interest rate cuts and the lower US yields as a result of it. Now, TD Securities say that the current positioning in gold is more consistent with levels that would suggest recession. So if you believe a recession isn't imminent, so gold prices may be perhaps a bit inflated. Now, it's true that the emerging market central banks have been buying gold to diversify against high inflation and also diversify away from the US dollar, and the uncertain geopolitical and uncertain financial landscape drive capital to the safety of the yellow metal. Yet note that Chinese consumers are reportedly cutting back their gold purchases these days due to high gold prices. The dovish Federal Reserve expectations look a bit overpriced, and the RSI index on the daily chart suggests that gold is about to step into the overbought territory as well, and correction could be healthy at the current levels. But yes, in the long run, gold's recent rise came as a perfect proof that gold remains that popular hedge for many investors and for many problems, and that's not ready to change. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.